Many deductions that you have require a cash outflow in order to create a tax savings. How that typically works is the amount of the outflow is multiplied by your federal marginal tax rate. The result is the amount of your tax reduction. Not so with the qualified small business income deduction, which requires no cash outflow for you to be able to receive, meaning more dollars in your pocket. But there are, frankly, a lot of rules and stipulations that can become confusing very easily. So in today's video, we are going to walk through specifically on how to plan for qualified business income deductions and a few things to be mindful of in order to be able to maximize your tax planning. So the first step is to define what QBI is. QBI allows pass-through entity owners to deduct up to 20% of their net business income off of their personal tax return. Pass-through entities are sole proprietors, LLCs, partnerships, and S corporations. But QBI also applies to some investments such as REITs and publicly traded partnerships. So your investment account could be producing a QBI deduction for you. But for purposes of this video and what is more commonly used for tax planning, we're going to focus specifically for business owners. So now that we know how much of a deduction QBI can create, what are some of the limitations related to QBI? The first obvious one is the amount that can be deducted off of your personal tax return. That is the cap of 20% of your net business income, which is pretty straightforward. From there, however, it can become very complicated quickly, especially if you own an S corporation. So let's dive right into that. The QBI for an S corporation is going to exclude your salary. That's where it becomes a bit of a balancing act because you are required to pay yourself a reasonable salary for your business. But the more that you pay yourself as a salary, the less that will be applied to QBI and the more that you'll pay in FICA taxes. But keep in mind that the amount that you pay yourself W-2 will determine how much you can put into a retirement plan because retirement plan contributions are tied to your W-2 wages. Are you confused yet? That's why I said it's a bit of a balancing act, which your CPA should know about and how to be able to advise you properly with this. If you've missed my video on how to pay yourself and avoid an IRS audit, check it out. I'm going to link it here below. Finally, there is another limitation to being able to take the qualified business income deduction, and that is your income level in the tax year. If your income becomes too high, your deduction is going to begin to phase out. We call that the phase out range. And if you are in the phase out range, your deduction is going to be limited to a percentage of your wages in your business or of your UBIA, which stands for unadjusted basis in qualified property immediately after acquisition. Honestly, I'm pretty shocked that they were able to get that many words into a 4-letter acronym. Basically, what this means is that you are limited to the basis you have in fixed assets in your business, which can be very helpful if you have a lot of fixed assets in your business. But if you don't, you'll be more likely limited to the amount of your W-2 wages. So what are some tax planning opportunities that this presents? Opportunity number one is managing your taxable income. As of this video in 2026, the phase-out range for married filing jointly in the qualified business income deduction is $403,500 to $553,500. So there is a $150,000 phase-out range where your qualified business income deduction is going to be reduced. And that's why I love working with business owners in this income range because there's a lot of tax planning opportunities that can bring a lot of value to the table immediately. For example, if your income is right on the cusp, you may be phasing out your qualified business income deduction because your income is $1 within the phase-out range. A hypothetical client of mine came to me in 2023 when the phase-out was much lower. It was roughly $363,000. His taxable income at the time was $389,000, which was very close to that phase-out range. And an idea here would be to implement a solo 401k into his business, creating a $66,000 deduction, pushing him below the phase-out range. A quick check for you to see where your taxable income landed and how close you are to the phase-out range is to go to line 15 of your 1040 tax return. Opportunity number 2 is to aggregate your business. If your businesses complement one another, one having a high W-2 wage and a low UBIA, and the other having low W-2 wages and a high UBIA, these two businesses can complement one another to help you create higher qualified business income deduction. Again, all of these conversations should be had with your CPA and financial planner to make sure it is implemented correctly. If you're walking the tightrope around the qualified business income deduction, give my office a call through the link below and ask for Kyle. My firm, Glenn Financial, works with Main Street business owners every day, navigating this question and other questions that we raise on our YouTube channel. If you found this helpful, please like and subscribe, and I'll see you in the next one.